You could tell someone they have an 80% chance of success, and in their mind, they think there's a 20% chance I'm eating cat food when I'm 80 years old, and that's not
Right.
actually it at all.
Hello, and welcome to another episode of the Advisor Upside Show. My name's Sean. I'm executive editor here at the Daily Upside. I have with me my colleague, John Manganaro, who's our senior reporter who covers the retirement beat.
Yeah. Hi, everybody. It's great to be here. Loving the podcast so far, Sean. It's great energy. Another great episode. So excited to be here.
Yeah, so today we're going to be talking about retirement, technology, tools, data, all of those things. And financial advisors have never had more of them, right? There's more data, more tech, more planning tools available. So we want to ask the question, why are some clients still struggling with those retirement decisions, and how can advisors help them make better ones?
Yeah, that's right, Sean. Technology is evolving faster than ever. Retirement is more complicated than ever, as we cover in the Retirement Upside newsletter.
Yes.
Keeps me busy. And clients' expectations have always been changing, but they're higher today than they ever really have been before. So today we're going to look at some gaps in financial planning, especially as it pertains to retirement income, spending in retirement, and long-term decision making about how to make the best of one's golden years. Joining us this week is David Blanchett, the financial planning expert who heads up retirement research for Prudential, and he's also a portfolio manager for PGIM. Guys, bear with me as I tee up this segment, and I think David's the perfect person to walk us through this, given his extensive research into the retirement planning field in general, but also the real nuts and bolts of planning. His field of research has been very impressive. So I think we'd all agree that today's financial advisors do a much better job of delivering genuine financial planning to their clients compared to the transaction focused agents of the past. But as David and I have discussed, there are still a number of important ways that the wealth management industry is falling short of its potential. To be blunt, advisors are in a position to significantly step up their planning game, thanks to the emergence of new technologies and a reconsidered perspective on traditional planning methods, especially as they pertain to saving and spending in retirement. So, in this segment, we're going to ask David to walk us through 7 flaws in modern financial planning. Please let us know in the comments if you've seen any of these in practice, if you're maybe guilty of some of them.
Mhm.
Don't hesitate to fess up. And of course, let us know if you've seen any other big ones that we've missed. So, David, thanks for letting me introduce that. The first sort of flaw that I'd like you to discuss is an over reliance on probability of success metrics. I've heard you say in the past that Monte Carlo failures aren't plane crashes, and I think that's a perfect way to summarize it. But what have you seen here, and how are sort of advisors falling short?
Yeah, so maybe taking a step back, right? I think that financial plans are really important, right? People need some sense of how much they can spend in retirement, how much they have to save. We've got to give them like a way to estimate what that is, right? Like how much do you have to save? When can you retire? And so we have to have an outcomes metric, like what is defined as good and bad. And so if we go back, you know, maybe a decade or two, what we used to do in this industry is analysis where we assume that like stocks, like your portfolio would go up every year by 6%. Like it's just like 6%, like that. Like that's just not like that's not realistic, right? Like, in
Yep.
reality, like you're gonna have good years and you're gonna have bad years. And so I think there's been this movement in the industry towards running financial plans that incorporate some randomness. And that's called Monte Carlo. It's this idea that, returns can be positive, they can be negative, good and bad things can happen. Okay. And so now, though, if you have these kind of like 1,000, trials or fake retirement, there's this question, well, like, how do we quantify that output and summarize those results for the end user? And I think what's been problematic is the way that we interpret those results. And so there's actually lots of different ways you could kind of take those 1,000 runs or trials, each kind of fake retirement with all these random returns and combine them. But what the industry is like overwhelmingly moved towards is this idea of the probability of success. And what that is it looks at each individual run and asks this question, like, did you accomplish your goal in its entirety? Like, and if you do, you get a 1. And if you don't, you get a 0. And the success rate is the average effectively of all those 1,000 or 5,000 trials. And so like where that is like just where it's crazy is like if you fall $1 short in the 30th year of retirement, you will have been deemed to have failed.
Hmm.
Right. And no one is going to be like, yeah, like, in that last year I fell $1 short, so I failed. And so I think the problem is that it doesn't provide the correct context around like how on track are you to accomplish your goal? Right. And so I think what people want is some sense of how they're doing. And I think that the problem is people don't interpret that number very well. Like you could tell someone they have an 80% chance of success. And in their mind, they think there's a 20% chance I'm eating cat food when I'm 80 years old. And that's not
Right.
actually it at all. And so I think the problem is that the metric doesn't define the true outcome, which is like we don't want shortfalls, but there's no sense of like the magnitude of failure. So I'd like to see us move towards like other definitions that talk about like, like what percentage of your goal do you replace on average, or kind of other approaches that focus more on like how much of the goal do you complete,
Yeah.
not just if you don't get all of it you are deemed to have failed.
Monte Carlo is a really powerful tool, but David, to your point, I mean, people see a 1 or 2 or a 5% chance of the plan failing, and that freaks them out, whereas that's actually a pretty good position to be in.
It's funny. People like blame Monte Carlo, but like Monte Carlo can do anything. It's not like this isn't like a Monte Carlo problem. This is a tools problem. I think that the tools that are widely in use by advisors, and for some of these tools, it's like in giant 100-point font, bold lettered underline. It's like the thing that advisors want clients to focus on because like it's mathy, it's numbery. Like people are like, ooh, this is a complex analysis, but I just worry that it leads to underspending because people fear this idea of failure when it's not really failure when you think about how things actually happen in retirement.
You kind of alluded to some of the ways that some better examples and maybe doing using percentile kind of based ways of explaining things, but just from like maybe more of just a human being behavioral, you see this failure and that's the opposite of what anyone wants to do with their life, especially their retirement. So obviously that's scary. How do you make it a little bit more realistic and show that context of if it's just a dollar, you're not eating ramen noodles every night or cat food, but you're still going to have a 99%, happiness of what you would have had. So how do you kind of portray that to clients when you sit and talk with them?
Well, so I think that I think a lot of advisors, a lot of people are captive to their own tools. I don't expect people to go out like me and program things up and figure out calculations. But I think that like at a minimum, like two ways to kind of better conceptualize the outputs if you can do it is one, look at if it's available, like what is the percentage of the goal that you accomplish on average, right? So right now how it works, it looks at each individual trial and it's a 1 or a 0. Just like average the percentage of your total income that you accomplished and divide that by the goal and then look at that across the runs if that's available. I think a more realistic thing to do is, as you mentioned, percentiles. So like, answer the question, like in the worst 1 in 10 or 1 in 5 or 1 in 4, pick your percentile outcomes, at age 95, at age 100, this is what your income is going to be because it's the income that matters, right? So have some sense of if you aren't accomplishing your goal, what does that actually look like?
Yeah. And I've heard, David, I mean, even the term Monte Carlo is pretty confusing to the typical client out there. I mean, they're going to think about a casino somewhere, off the Mediterranean in Europe, maybe think of James Bond. It doesn't, we need to break these ideas down and make it just a little bit more human for sure.
Advisors aren't going to change the tools they use, but like don't show your client the number. Like I don't know if you show them like a sun or like rainy clouds or like an upset puppy, whatever. Pick your picture, but don't give them a number with all they want to know is am I going to be okay?
Yeah.
And I think like you either effectively say yes or no, or maybe like there's a maybe, but trying to like, there was a Monte Carlo tool that did 100,000 runs. You could like tell someone they had like a 58.752, like it's just meaningless. And so I think that like we need these tools to guide us in terms of what is reasonable, but how we relay that to the average human who's not like a super numerical individual that understands the nuances of this, it isn't always very useful.
Yeah.
Hopefully, if the advisor does their job right, they can afford that trip to Monte Carlo off
Yeah,
the
that's right.
Mediterranean.
That's the end goal, right?
Hopefully. So the next sort of shortcoming, and I think this maybe pertains more to the savers and investors themselves, maybe less to financial planners, but it's this real obsession with portfolio returns. And of course, we want well priced, high quality investments, but it's not that top 1 or 2% of the return that makes the difference for long term retirement planning. What would you say, David?
As a portfolio manager, I can say this: like, you cannot solve retirement with an efficient portfolio, right? I think that people like beat themselves to death. Like, I'm gonna,
Yep.
build this portfolio and get great returns, and that is important. I'm not suggesting it's not, but like retirement is more than just it's much more than just a math problem, right? I think that, like understanding how you structure your assets against your liabilities, like what does the portfolio mean for you? It doesn't help you to have like a really efficient portfolio, for example, and to have one that you're always worried about and so you can't spend money. So I think in reality there's a lot of balance at play in terms of figuring out like what is the right way to build a portfolio and how does it help you actually enjoy your retirement versus maximize your returns.
It just reminds me, Sean, of the coverage we do in the ETF upside, and we're always looking at these, interesting new ETFs. Some of them are leveraged, some of them are really seeking returns, and sometimes, that's very interesting to our readers. But it's when I put my retirement hat on and I'm reading about these leveraged ETFs, sometimes I think, oh, are these investors kind of missing the point? Sean, does that ever occur to you?
Uh, well, I mean, I think for the right investor, the leverage and those products, the derivative based stuff has. I mean, it's certainly more day traders and people that are very active traders, and even right on the prospectuses, they say do not hold this more than 24 hours. You're not going to see it in a guide path anytime soon from in a target date fund. But I think that might be illegal, maybe. But yeah, I mean, I think they do have their place for sure. And there's all different products for all different investors. And yeah, probably not something that you're going to see in David's portfolio construction. But I don't know. I'll let David weigh in as well on some of those products.
One of the things that I actually did some research on is FOMO. Regret is the research word, okay? And I think that like we are all human. We all experience regret. And so, I don't want people to go out and own inefficient or volatile assets. But like, if you feel like you have to do that, do it with as little as your portfolio as possible. Like, to your point, like leveraged ETFs, like they're not a long-term holding. But like, if you're someone that really enjoys, trading the market, like I can't tell someone not to do that if they want to. But what I can tell them is to kind of minimize the impact that could have on their wealth should things not go their way.
And usually, I think when you see it in portfolios, you see it in the small kind of play money. People would
Yeah.
say almost a casino money, where it's a 1-2%, whatever it is, but something small where you can get out those experiences and urges and animal instincts to go trade the markets, but it's not infecting the core portfolios. So.
I don't love the idea of lighting that 5% on fire, but it's better than lighting the entire portfolio on fire, right?
Kind of moving right along here, and I know this is near and dear to your heart, David, but a lot of people, advisors included, have what we'll call unrealistic expectations about retirement spending, and I think that comes in a few flavors, right? Like some people expect to be able to spend too much, perhaps, but I think the real thing is that people expect their spending to be very equal and measured in retirement. Doesn't really look like that in practice.
There's kind of like two different parts to like the retirement equation. There's like your assets, right? That's your portfolio, and that's like capital market assumptions. And I think advisors spend a ton of time like thinking about how do I build efficient portfolios? Is it like 12.2% to small cap or is it like 12.1%? I think a lot of times there isn't the same kind of focus on the goal or the liability. Right. So like the retirement goal, the net present value is like the most expensive purchase you're going to make. And so it's really important to think about like all the assumptions that we use in our models. And so, a really common assumption in a financial planning software is that people are going to increase their spending every year in retirement by inflation, no matter what. Doesn't matter what the markets do, no matter what happens. And no one does that, right? Like no one like calls their advisor up and like, hey, CPI was up 3% last year. I'm going to spend 3% more this year. But also like it doesn't acknowledge the fact, and I've done research on this and others have too, that people tend to spend less as they age. Right. So like if you look at the average retiree, they spend about 1 or 2% less versus inflation. So the total spending is increasing in nominal terms, but in today's dollars, it's going down. Right. Another thing that I alluded to as well is just this idea that like, people react to the markets. And so if we think about like what's going to actually happen in retirement, if you're retired and the market crashes, you're probably going to pull back on spending. Right. Well, like in the vast majority of tools today, Monte Carlo tools, there isn't an assumption that any changes are made. It assumes you keep following this path for the next 20 or 30 years, and that doesn't track reality. And so again, it's not really possible to know exactly how someone's going to respond to like different market outcomes, but incorporating the fact that you're probably going to make a change at some point in the future if you have to can radically affect like how much you can spend today. So again, like this is kind of a tools problem. I think that we need to have, tools that better reflect how we spend in retirement. But like, what the net here is though, is that if you incorporate these things into a model, you can spend more earlier in retirement, when you're more likely to be able to actually enjoy it because you're healthier.
I was going to ask, why do you think that spending goes down in retirement? Is it just the fact that the fear of running out of money? Obviously, I would think that spending because of long term care costs and things might increase as you age, but you said that actually it is dipping, or how
So,
does that work?
so much to unpack here.
Go down the
All-
rabbit hole here.
Yeah, here we go. Here we go. But so, I mean, okay, high level, it is very true that healthcare spending is a rising share of expenditures as we age. So, for the average household age 65, about 10% goes to healthcare. Okay. Fast forward 20 years, age 85, closer to 20%. So, healthcare is this rising component of spending. We all know that healthcare rises faster than inflation. That's like a well-known fact. But everything else goes down. Like I think like the most fun model of this is this idea of like the go-go, the slow-go, and the no-go years. It's just that people actively choose to spend less as they age on average. And you can see this in the data. So like, yes, a lot of Americans aren't on track to replace their pre-retirement income when they retire. Even if you just focus on just those individuals who have like tons and tons of money, they still also tend to spend less on average as they age. I think it's just that like one of it's just because we just can't do stuff, right? As
Yeah,
you get
right.
older, if you have a health issue, you can't do the same kind of activities. And so again, like there's always going to be that one retiree that spends more over time because they're healthy, they want to do things. But on average, people just tend to do less fun stuff, less kind of
Yeah.
once types as they get older.
Yeah, I mean, I think if we all reflect on some of our, parents, grandparents, we see that play out. Like I think about my grandparents, they traveled a lot when they were, newly retired, saw the world, and just very naturally they slowed down over time.
Yep.
And then, my grandma suffered from dementia. My grandfather had his health issues, and they really spent a lot of money on that towards the end of their life. It's just sort of a natural path through the end of life. This episode is brought to you by the Retirement Upside. Let's face it, there's nothing simple about retirement planning. When should your clients claim Social Security? How much can they safely withdraw each month from their 401k? What about the right mix of stocks and bonds for a 30-year retirement? Don't even get me started on optimal Roth conversions and inherited IRAs. I could go for hours. We launched the Retirement Upside to bring you the answers to all of these questions and more. We come to you in your inbox every Friday morning with the latest news and expert views affecting your clients as they prepare for and navigate life after work. Subscribe today at thedailyupside.com. Kind of related to what we just talked about, but just a broad failure by advisors, I think, by the public to just consider the role of guaranteed income, whether that's Social Security, whether that's the purchase of an annuity. It's just not really a focus in planning. And I know, David, that's something you think about quite a lot.
There's so much literature on the value of guaranteed lifetime income, right? And I mean, to be honest, like the vast majority of Americans already have some guaranteed lifetime income, right? Whether it's going to be Social Security, some kind of public pension. Like most Americans have lifetime income, but I think that the one thing that I have found is that people can often use more, right? So like Social Security, I know there's a bit of a mess these days with the trust fund and all that, but like it's the only thing that you can buy that provides income benefits for life linked to inflation. Right. And that, tax advantage, spousal survivor benefits, like that is incredibly valuable. Right. And, for most people, they say like, oh, I'm going to do a break even analysis and all this stuff. But like risk is not like dying when you're 75 years old. If you die when you're 75, like your kids, your spouse, it's all your stuff. Like retirement isn't a risk. Risk in retirement manifests itself if you live to age 95, age 100, age 105, where there's this possibility that you are all of a sudden becoming a burden on your loved ones, where you move from like this idea of I'm going to leave a bequest to actually I'm going to pull money from my kids to support me being alive. And so I think that we don't often think about like the true nature of the risk correctly. And I also do wish like we thought more about guaranteed income as like an asset. Like I'd love it if like in every single like retiree balance sheet there's like a value estimate of the net present value of Social Security, because for a lot of our households it's like a $1 million plus government inflation linked bond. So there's really important like portfolio implications about how we think about like risk capacity, risk tolerance, all these different things when you think about guaranteed income more holistically.
I did catch your presentation, David, at the Horizons conference. With Michael Finca and some other researchers. It was I love the tips you guys gave about using tips to bridge to Social Security.
Yep.
We did an article about that for the Retirement Upside. I'd suggest people link to that. I think this idea of using liquid assets to delay Social Security is very powerful.
honestly, like, I don't have a strong preference about how you fund the bridge. Like, you could buy an annuity, and if you can invest in stable value, you could put it in cash. To me, it's just like there's nothing else out there that provides the same kind of like economic benefit, value, rate of return, all these things smashed together as delayed claiming. So, to the extent someone, one is reasonably healthy and two has the assets to afford to do so, it should definitely be a top consideration.
Sean, I actually had a quick question for you. Being a financial journalist, I often get questions from my friends and family about things like Social Security, and there's a ton of worry out there. Sean, do folks ask you about what to do about Social Security?
My mom did, and then didn't take my advice. So no, not a lot of. Yeah, I mean, to David's point, just I'm not a huge retirement expert, but I did tell like my own parents like try and delay claiming because of all the benefits. But even there, some people just are want that income then and there, and it makes sense for some people it doesn't. It's such a personal choice. But yeah, I did try and tell them that. And actually, to the tips point, I did buy a tips when inflation was like through the roof because they were getting like 9% or something, whatever it was. And then we wrote that story on tips, and I didn't know, but actually it increases the principal
Mhm.
too in those. And I owned one. I don't even know that.
Yeah.
So the benefits, sometimes you don't even know all the benefits when you get into it. I just saw the headline of the yield being up, like I think it was like 9%, and you could hold it for like 5 years or something. And then obviously they change over time, but it was
Yeah.
it was super interesting. I didn't even know all of the benefits. So there's a lot of tools out there to bridge those gaps.
That was fun as we were working on that article, Sean. 'Cause we were both learning together. And
Yeah.
I assume the listeners know, but a tip is Treasury inflation protected securities. It's a type of government bond that was really in vogue several years ago when inflation was sky high. We'll see what happens with the rest of this year and next. We could be having tips conversations all over again. We'll see. Um, okay, so two more shortcomings that I want you to talk about, David. The first one is treating risk capacity and risk tolerance as the same thing. Can you unpack that for us?
Sure. So, risk capacity is how much risk you should take given your situation. So, in my previous example, if you have like lots and lots and lots of guaranteed lifetime income, that's kind of like a bond, right? So, if you think about how bonds, they pay a coupon, right? For some certain term, you can think of guaranteed income as being a bond. Okay. The more guaranteed income you have in your portfolio, okay, as your overall holistic portfolio, like the more risk that you could take with your remaining assets, your investable assets. So that's risk capacity. So risk capacity is like how much risk you should take given like your overall situation. Okay. Risk tolerance is how do you feel about taking risk. Some people are very aggressive. They don't mind if the market goes down 20 or 30 or 40%. Other folks just absolutely freak out. I think what's really important is like when I think about like how to determine the risk of a portfolio, risk capacity is where you should start. Then you should adjust that on the margin based upon your risk tolerance. So for most people, there are exceptions. Risk capacity, I think, should dominate how they invest, not risk tolerance.
I think again, there's also a behavior aspect to the risk questionnaires where you think you're a 4 risk, but really, you're not, or you're a 3 or you're a 2. I mean, everyone hates obviously to lose money, but I think a good way to frame it was an advisor that I talked to was just like if the market drops 25%, what do you do? Do you sell? Do you panic? Do you buy? And when I thought through that, like obviously you can't sell. Those holdings just that were in equity, that were liquid, are now illiquid until the market comes back. So, that kind of was a lot about my own person. I thought that I was pretty aggressive, but when I heard that, I thought, all right, maybe I'll pull it back slightly. Obviously, I'm not going to go and sell those positions. To me, that would be foolish. But
Yeah.
would you buy, do the Buffett thing? And, so it was just an interesting way to think through those. I think they could be a little bit dated. And to David's point, just trying to think through those a little bit more to personalize them to your clients is helpful.
100%. We've kind of already talked through this one, so maybe we'll go through it very quickly. But underestimating longevity and health complexity. But my favorite point here is that, a lot of folks who are healthy at age 65, they're going to live quite a long time, and it's very likely that at least one member of that couple will need something like long-term care. I mean, it's just a huge planning challenge that we all need to acknowledge. I don't know if you add anything to that, David.
These are very interrelated, right? So if we think about Americans today, Americans that have like are in the top two deciles of wealth are going to live 3 to 5 years longer than the average American. If you're someone that saved a lot for retirement, that's probably you. And so, the longevity statistics that you hear in the media for newborns, those are irrelevant. Even for 65-year-olds, like you're going to live longer than average. Well, one thing we still haven't really solved yet is that the longer that you live in retirement, the probability of having some kind of like healthcare shock, long-term care expense just increases almost exponentially. And so, not only are you dealing with this idea that I have to kind of, potentially, put aside money to live longer, but the probability and the implications of some kind of healthcare long-term care shock just increase as retirement increases. And so this is really difficult because for most folks it isn't actually an issue. So we look at like how spending changes in retirement. Like for most folks it just tends to like keep going down, but one in 5, 1 in 10, based upon how you cohort it, have these huge end of life shocks. And I think that's going to become more of an issue over time as we keep seeing these improvements in longevity, where the wealthiest Americans are going to live longer, but not necessarily better retirements at the latter stages of their lives.
It's frankly fairly worrying to look at some of those, trends and to game out, how challenging it could be. Sean, we were talking this morning about this idea of the great wealth transfer, and I was raising the point that, you know, in my mind, I mean, it's an open question, just the huge amount of money that people may need to spend on care and sustaining their lifespans. Some wealth transfer will still happen, but it's pretty worrying.
Yeah, that's for sure. I can't wait till the great wealth transfer happens so we can
Yeah,
stop, right? We've been talking about it for 15 years, so I'm hoping we have
it's
seen some
coming.
studies where it is actually taking place now, and there's a horizontal to the spouse and coming down. So, yeah, I mean, no, I think it'll be interesting to see how that plays out. But I never thought about long-term care and that and how that plays into it. I'm sure maybe some of those studies did. I'm sure much smarter people than me putting those together. But yeah, it's interesting for sure.
I think I said there were seven at the top. So confusing wealth maximization with retirement success. I mean, money doesn't make you happy in retirement. It's that simple.
Like, to be fair, the more money you have, the happier you are on average. And so there is a very positive correlation to wealth and things like retirement satisfaction, financial well-being, all these different things. But and this is the asterisk, is you cannot get all the way there if we just focus on wealth. Right? There are other things like health, social connectivity, like lifetime income. There's all these other things that are going to move the needle more than just wealth when it comes to retirement outcomes. But I think the key is that I think the problem with our system, a huge fan of 401ks, is that like you accumulate this pot of money, and you're trained for 30 or 40 years that you shouldn't spend it, right? You want to see it grow up every single quarter. And now there's this idea that you're supposed to like spin that down. You know how long you're going to live, and inflation and health and all these things. And so I think what we've created is a focus on not spending. What we should focus on is creating strategies that really make sure that you kind of maximize your retirement enjoyment. And those are often two very different things. And so like one of the things that I found in research with Michael Fink at the American College is that like people like they will not spend down their portfolios. Like the number one rule people use in America today is RMDs. Like the only reason people access the money is because of government tax policy. Okay. In reality though, if you look at like how people use like lifetime income, they actually spend it. And so I think that, there's this kind of there are obviously these competing forces, but if the goal is to create the happiest retirement possible, that could very much be at odds with kind of maximizing your wealth.
Well, David, thank you for stepping us through those. This was a great segment. We really appreciate your expertise. I've already had the opportunity to feature you a few times in the new Retirement Upside newsletter, which we launched just a few months ago. If folks have enjoyed this conversation, please head across and subscribe to the newsletter. You'll get insights from David and the other folks who we've talked about and many other experts. So encourage you to check that out.
I mean, we appreciate your time, David. Looking forward to the research. That sounds super interesting, and I can't wait to do it again with you. Thanks for being on. All right, everyone. Well, that's our episode for this week. Thanks for listening. We appreciate it. We want to remind you guys to also check out our newsletters. We have 3 of them now. We have Advisor Upside, ETF Upside, and also Retirement Upside, which is what John runs for us here at the Daily Upside. in addition to obviously the Daily Upside, which is our flagship newsletter with about 1 million subscribers. So plenty of content. We come out every week. As we alluded to as well at the top of the show, we have plenty more products coming out. So hopefully you won't get sick of us, but we have some new newsletters coming out towards the end of the year. They're going to be monthly and have special topics aligned to them. So look out for that. We also have a bunch of videos and some other multimedia stuff coming up in addition to our new podcast. So we're keeping busy. We're having fun. We hope you're enjoying it. And thanks again. John, I'll kick it over to you. Any final thoughts?
Yeah. Please go ahead and subscribe to the Advisor Upside Show on your preferred podcast platform. If you're only listening to the show, please be aware that we're also on YouTube. You can see Sean and I and our guests each week. If you have feedback or questions, please get in touch. You can email us at podcast@thedailyupside.com. Again, that's podcast@thedailyupside.com. My information and Sean's information is also available on the website. So if you have a news tip or want to get involved in any of our newsletters, reach out. We really want to create a community here and make this a two-way street. So I think with that, Sean, we can close the episode. Hope everybody has a good one.
Thanks, everybody.